It's Friday, May 30th. The market just closed. We want to give you a quick market update and outlook. We're 5 months through the year now. Today's the end of May. We had a strong May, up over 5%, one of the best Mays I can remember. It's usually a quieter month. We have just 20 trading days, 30 more days until the year is halfway finished. It's going really fast. And 5 months in, we've had a very exciting 2025 so far with tons of volatility, crashing down, rallying back up to make zero progress in returns. And why has that happened? Why are we 5 months into the market with no gains in stocks? And the reason is pretty simple. We talked about it at the beginning of the year. We just had a 60% rally in stocks in the S&P 500, NASDAQ in 2023 and 2024. We came into 2025 at 22 times this year's earnings. It's extremely full. It's not a bubble, but it's extremely full in price. And the market needs to go sideways to give time for the corporate earnings to actually catch up to the price expectations of those earnings. So that's what's kind of happening here. And at 22 times, there's so much gains in the market and a little bit of froth in there that takes any kind of news to knock it down. And this year it was tariffs. It was the whole Trump tariff policy, and it was very volatile. And that's now really quieted down, and hence you're seeing some stability in the market. And you know it's being quieted down by the administration because you haven't seen Navarro anywhere. They've tucked him in the basement of the White House, and that's a good sign that they have learned their lesson, that they've got to kind of handle this in the right way. The market is also gaining confidence that Trump says he puts 50% tariffs last Friday on Europe, and by Monday morning he takes them off and gives them 2 more months to have negotiations. So the market is taking those threats a little bit less likely to be real. Everything is moving to our script for this year. Our outlook for the rest of the year, as we've said from day one, we're looking for an upward bias on stocks, nothing crazy, 8 to 15% at the high at the most, but somewhere in that 6,000 to 6,500 range probably at the end of the year. All of that goes out the window if we have any geopolitical event, like Ukraine heats up again, or there's some other skirmish, or Iran does something, or something in the Middle East, etc. So then all bets are off. But in the meantime, everything is playing to our script. Why we're bullish for the rest of this year, especially into the fall, as we begin to price in 2026, let's go through those reasons. Number one, the Fed is in a easing mode still. They haven't cut rates in quite some time, but their next move is probably a cut, not a raise in rates, and that will be bullish for the market. We'll go through why the Fed should be cutting now in a few minutes. There is $7 trillion in cash sitting on the sidelines. It was $6 trillion at the beginning of the year. So people, as the money is generated, it's not going into the stock market. It just scared everyone. Plus all the big hedge funds, many of them got liquidated for selling down at the lows because they run their money levered, which means they borrow a ton of money to buy stocks, and as the stock's correct, they get margin called out of that. That money has to come back into the market. So we've, just on a fundamental basis in corporate America, we've got this massive buildup still going on in artificial intelligence. Right now, it's kind of in all the technology companies are building their infrastructure, whether you're manufacturing chips or your databases, et cetera. It is eventually, over the next 10 years, it's going to expand into every nook and cranny, every country, every military, every corporation in the world is going to need to upgrade to these higher systems that are being embedded right now. So that's really positive. That's a real more macro theme underlying current that's going to be carrying this market. It's going to be, if it's a 9-inning game, we're in the second inning. We've got a long way to go. Basically, probably the rest of my lifetime is probably going to be this build out, just like the last 20 or 30 years for the internet build out from the 90s. We had that great stock market in the 90s. It would then correct heavily, but it would take another 20 years for everyone to use the internet in mainstream living. And now you can't even imagine life without it. The same thing's going to happen with this whole nother wave of technology. And we're in the right stocks for it. We made a lot of money, understatement, a lot of money in some of the right tech stocks. And we're going to talk about those in a second as well. Why I think the Fed should be cutting rates, I think they should be cutting now. I think the main reason is you've got it's an overnight lending rate. They should be below the rest of the yield curve. 2-year notes are trading at 3.9%. The Fed funds is 4.5%. That should go, that's inverted, that should right itself. I think that's going to force the Fed in eventually. You've got the deficit is getting more and more expensive at higher rates. They're going to need to cut rates just on a fiscal policy, just to make it more affordable for us to carry our debt. Why else is the Fed? I'm looking at my notes here. The tariff noise in the second half. Tariffs are not inflationary. Tariffs are a tax. Okay, it's a one-shot deal. It's not traditional inflation. Inflation is run where there's too much money chasing too few goods, like we had during the COVID crisis. That's not the case right now. The tariffs, Fed keeps saying tariffs are inflationary. but it's a one-shot tax. Once the policies are set, they're in place in there. They're not going to be subject to flows and money and stuff. And so you've got that. You've got inflation numbers across the board. They're generally softening. Inflation is very tame right now. You've got GDP softening. And I think the Fed should be doing it primarily to make housing more affordable. We're still above 7% in mortgage rates. It's tough. It's just the housing market has kind of gotten really sluggish. Car loans and student loans would all be more attractive. So I think just to help the population, they're going to need to cut rates in here. If they don't, GDP is going to start drying up. We'll start moving toward a recession. Right now, that's not the forecast. We also like the market because we do think that as we move into the second half of the year, we're going to have better visualization on deregulation and the tax policy that's coming. And those are going to both be bullish in here. And then hopefully by the fall, all this tariff noise is kind of settled and behind us a little bit. So we will see. So we kind of have a target of somewhere between 6,000, which we're almost at, to 6,500 on the S&P. Again, high single digit, low double digit kind of year. But when you combine 23, 24, and 25, that's a really great run in here. We get really excited. Earnings are looking really good for 2026. And we think we're in the right stocks, which we'll get into in a second. I'll shift gears and talk about a change in strategy we made on the platform this year. At the beginning of the year, we run two strategies here. We run our core portfolio, which is more of an endowment style approach, and then we have strategic portfolios, which are a little bit more aggressive. Core has mostly mutual funds, index funds, and ETFs, and strategic has all of those plus individual stocks. Okay, we began to learn that our individual stocks, our ability to find these rapidly growing companies and maintain positions in high quality companies was driving performance in strategic versus core. And we decided that we would take 10% of the equity sleeve to start in core and buy our top 20 individual stocks. So we are buying the top 20 stocks we own as a firm, which we're going to start posting at some point. We are posting those 20 stocks on our social media, Instagram, Facebook, X, and we'll try to get them on the website. But these are a position in 20 stocks that we have held for a very long time. And it's names like, you're going to know every name pretty much on the list, but it's Apple, it's Amazon, it's Berkshire Hathaway, Costco, JP Morgan, Goldman Sachs, Home Depot, Eli Lilly, Microsoft, NVIDIA, and then this company Palantir we've owned for a few years that's just gone through the roof. If you had owned Core 20, and if you're a new investor looking to start a portfolio, or you are an investor with cash to invest and you really don't know where to start, you can start with these 20 stocks. It is about 50% in tech, which is a little high, but the S&P is a third in tech. The S&P 500 is a third in technology. These are really strong companies. So it's weighted toward technology. But if you owned our Core 20, despite the volatility, you're up 2.5% versus 0.5% for the S&P 500. So we've outperformed by, it's actually 1.93 percentage points in the first 5 months of a flat market. If you held these in 2024, you were up 66% versus 23% for the market. So 43 percentage points, that's 4,300 basis points of outperformance. And if you own them all of 2024 into 2025, you actually made 78.5% versus 24% in the S&P 500. So 55 percentage points, of outperformance, 5,500 basis points. So massive outperformance in here. We wanted to get those into core. And we love these positions. You will see a stock get kicked out of our 20 and maybe one or two added. We don't have to stay at 20. We can go to 25, we can go to 18. But this is going to be a new strategy in here because we continue to make most of our wealth creation in individual stock picking versus the broad index. It's been an easy market to beat the index in here. On a mistake side, we cut out international this year. I was so frustrated with international stocks. It's been anchoring our portfolio and helping us lag our potential. That is now, they're having a great year. The EFA International Index is up 17%. And we missed it, but I think it's a kind of a short-term thing because we went through our correction. And if they didn't bring up this tariff thing, our market would be up 15%, 20% right now too. So we'll see if we get that in the second half of the year. I just think all the future growth and innovation is going to be happening in the States, not overseas. Our regulations over there, we have the better system to grow money and grow wealth faster. So that's our shift in strategy. We are so excited about a few of the stocks in there. My favorite stock right now, this is not a recommendation to buy it, sell it, do whatever you want, but my favorite stock, just personally speaking, is Palantir. It's been NVIDIA that hasn't gone anywhere, but Palantir is where NVIDIA was 5 years ago. It's I don't know, market cap right now is something like 300 billion. It's going to $1 trillion bucks. In the next 15 years, it's probably going to $3 trillion. Every single government and military will need their defense systems if you want to remain safe and competitive, in geopolitics in the world. As Alex Karp says a couple of times, our products are so lethal that we shouldn't even be allowed to be selling these to our allies, let alone enemies. In every corporation, every government, every military department is going to need to be accessing their software to analyze all of the data and figure out solutions and productivity and efficiency really fast. There was on the tape today, Palantir was up today, even though the market was flat to down, because Trump is now bringing on Palantir to work more involved in the government. So the IRS is going to have access to Palantir products, Department of Defense, the Pentagon, Homeland Security, Social Security Administration. So, and this is all going into this one little small market cap company. They're hugely bullish in here. They're growing like crazy. If you owned it since the beginning of 2024, you're up 612%. We've had that in our portfolio. One of the things I'm doing differently than I might have done 10 years ago is we're allowing positions to run. When you work at a wirehouse bank and any brokerage firm, compliance just is designed to protect the bank. And it leaves so much potential returns. And if you know what you're doing and you understand the companies you own, allowing positions to grow and expand to their full potential, it's against conventional diversification norms. But I'm finding diversification is weakening our performance because there aren't that many rapidly growing companies. So we've allowed our NVIDIA position, has now passed several of our, it's close to 20 million bucks. It's now, and it started at a couple of $1 million a few years ago. It's passing the Vanguard Total Stock Market. It's passed IVV, which is the S&P 500 ETF. Right now, I think just our NASDAQ 100 QQQ ETF and VOO, the S&P 500, is now bigger positions than NVIDIA. Palantir is right behind it. It's worth about 15 million bucks. I think we've got $1 million cost basis. So yeah, all good stuff there. But if you own JP Morgan and Goldman Sachs in our portfolio for the last 2 years, you've made 55% in both of those. So it's not just about technology in here. I'm going to wrap up today on temperament. We have had a textbook lesson on temperament and investing, and I think I want to try to convey, over the course of a lifetime, there's more risk being in bonds and cash than there is to being in stocks. You need to develop the temperament that you have to expect when you invest, that these markets that showed up into the April lows, that's a fact. That's a fundamental part of investing. We kept saying to you, stay the course, because this is very normal, not even extreme price action in stocks. And Warren Buffett says it all the time, if you're not comfortable watching your portfolio go down by 50%, you shouldn't be in stocks. So did we know the market would bounce so fast back? No, of course not. We never know what's going to happen. But we know how history plays out. We've been doing this for so long. We've been through these. When it comes to my own personal investing, I worry about the clients. I worry about the team. I worry on a lot of things. I never worry about my own portfolio. I never worry about my safety financially because I know the companies I own very well and I'm very comfortable with them. And the companies are going nowhere. This is just a stock market thing. So I'm typically buying on episodes like that. And if you sent us money in the last 5 months, your portfolio is actually up this year even though the market's flat. So you need to develop, and we've all hopefully learned a lesson. I hope the next time one rolls over, you begin to recognize this is all normal price action in stocks. And if you had bought a bunch of stocks on January 1st and fell asleep and woke up today, you would think it's a boring year, and it's anything but. So that's where you want to develop your temperament. Just because your net worth, your portfolio go down, it doesn't change anything. As long as you've got money in the bank to pay and have a job and be able to pay for your food and your housing and your insurance and everything, then let those prices whip up and down and use them to your advantage. We're sort of in a hold right now. We're not really chasing stocks up here. They've had such a massive run. We've been chasing them for the last 5 months as they broke down, and it was a little bit like shooting fish in a barrel. So yeah, we want you to keep developing your temperament in here. And I'm going to close on just saying I'm going to try to do more of these, but I'm not going to keep sending the emails out to the clients. I don't want to kill your email box. You'll just unsubscribe from them and won't get our news. I'll leave the email distributions with the link to YouTube for the clients for very monthly or quarterly kind of talks. But if you subscribe to the channel, number one, you'll help us reach more people because it kicks in the algorithm. So we really appreciate that. We think this content is valuable to average investors or sophisticated investors. But it'll also give you notifications if we put something out just on a random Tuesday night for 5 minutes, which I'd like to start doing more of. I just don't want to kill your inbox. So with that being said, it's been an exciting 5 months of the year. We're back in the black, and I just wish everyone have a great weekend, and we'll talk to you next week. Bye.